Hi, everybody. My name's David Sakowitz. I am a partner at the law firm of Winston Strawn. In pre-COVID times, I was splitting my time between our New York and London offices. I have now been stranded in New York for a little over a year, but hoping to get back to our cross-border practice in person as soon as that is possible. And we are a full-service law firm. My practice has been a full-service capital markets practice for many years, so I have a long history of representing both issuers and underwriters in debt and equity transactions, public and private deals, and also doing a fair amount of compliance and corporate governance work. But like the rest of us, we've gotten increasingly involved in the SPAC space in recent years. Winston Strawn was actually one of the early adopters of the SPAC model among law firms. There was a time that I remember quite vividly when not a lot of law firms would touch this structure because it was viewed with some disfavor in the market. Obviously, nothing can be further from the truth these days, but we were lucky enough to get in on the ground floor several years ago, and just particularly in the last year and a half have been crazy busy as everyone in the space with both IPOs and de-SPACs. And so my role is on both ends of the transaction. At the front end, I work with issuers/sponsors and underwriters of SPACs to bring them to market. So when we work with a sponsor group, we help them with refining their story and their track record description and the vision that they have for the SPAC, together with their investment banking advisors. We prepare all the legal documentation. The main one is the registration statement with the SEC, and then there's a bunch of ancillary documents. And then we work with the team, including the accountants and the accounting consultants and auditors and the underwriters and their counsel, in order to get the SPAC IPO done. And then once the IPO is done, we move to the de-SPAC process, which is by far the more complicated part of the process, where we will essentially hold our sponsor clients' hands through the process of identifying a potential business combination, negotiating with that target, and then ultimately working with them and their investment banking advisors to negotiate an LOI, a definitive agreement, raise the pipe that most often accompanies the transaction, and then moving things forward to the closing. And I would say that on that end of the process, I handle the capital markets end of things, and then we have a team here at Winston who handle the pure M&A aspects of the transaction, with whom I work closely every day. And we're lucky enough to have, I think, the premier SPAC M&A team among law firms in the country. We also do a fair amount of target side work, and by that I mean private companies that are considering various alternatives for growth and capital raising. So a lot of times a company will come to us and they say, they're not necessarily sure whether the de-SPAC route is for them, or whether they want to pursue a traditional IPO or some other option. And then we work with them to analyze each of those pathways, including from the perspective of public company readiness, because frankly, a lot of private companies who come to us are not quite ready for prime time. And if that's the case, then we advise them as to what they need to put in place in order to get ready, including having the relevant financial statements, the relevant financial controls and internal controls and procedures in place, corporate governance structures, and just generally becoming ready to be a publicly traded company. And so we provide that kind of advice for targets as well. I feel like these days our de-SPAC practice is probably about evenly weighted between the SPAC side and the target side. So we're lucky to see both perspectives on that. So in terms of a spring market update, in recent weeks, the market has been choppy. We were going like gangbusters with SPAC IPOs for full months of January and February. And just in March, it seemed like people are taking a breather and reevaluating. So a bunch of our deals are on hold right now and waiting for the next market window, which people do expect to open fairly soon. But I think there's a couple of things that have gone into why the market has been so relatively choppy in recent weeks. One is there's just an incredible glut of SPACs in the marketplace right now, and some of our target side clients are having 5 or 6 SPACs compete for their attention, and so a lot of times when we represent targets, we have kind of dueling LOIs going with 5 or 6 different parties, and we're kind of negotiating the best one to go forward with. So there is a relative lack of highly qualified targets to go around, and so I think a lot of SPAC sponsors are cognizant of that and as they're proceeding through the IPO process. I would also say there's an increasing sense that more regulatory scrutiny is coming down the pike here. I guess the first inkling of that was last fall when Jay Clayton, who was then the chair of the SEC, gave an interview with CNBC where he talked really just for like 3 minutes about SPACs. And 2 minutes of that interview was dedicated to how great SPACs are and how wonderful it is that it's offering an alternative to private companies that are looking to access public markets. But then he did say that the SEC was starting to have concerns about transparency with the SPAC structure, and in particular with respect to the incentives that the sponsors of the SPAC have both at the IPO stage and then particularly at the de-SPAC stage. So that, as far as I can tell, that one remark sent the SPAC market briefly into a tailspin last fall, and then there was a quick recovery from that. But then, there has been some additional, not rulemaking, but guidance from the SEC on exactly what SPACs need to be thinking about from a disclosure perspective. And then there's just an increasing sense, at least in the legal community, that particularly with the change in administration in Washington and with a new Democratic majority on the SEC, that they're taking an ever closer look at the SPAC structure and whether or not everything about the structure is adequately disclosed to investors. I guess a mini trend that we have observed recently is that some operating companies have started to set up their own SPAC subsidiaries in furtherance of an acquisition strategy, which is entirely new this year. Previously, the idea was that you could never have a particular acquisition target in mind for a SPAC. Otherwise, you would have to disclose that target's business and financial statements in the SPAC IPO prospectus. But it seems that at least in 1 or 2 cases, the SEC has signed off on an operating company forming a subsidiary that is a SPAC with the intention of ultimately merging both with the operating company parent and then with 1 or more other third-party targets that are private companies. So it'll be interesting to see how that structure plays out and if it becomes more widely adopted in the marketplace. I've only seen a couple of them so far, so I don't know. I don't know what's going to happen with that going forward. So those are the recent trends that I've been observing, but happy to talk a bit more in detail about what the SPAC IPO process is like, what the de-SPAC process is like. But I think for now I should probably turn it over to Vikram or Eric.
I'm happy to go next, Eric, if that's okay.
Of course.
Morning, everyone. Very nice to be here and appreciate Kontakt's host, Marianne, Sissy, and Zuri for coordinating this. Thanks for having us here. My name is Vikram Devanga. I'm a partner at CohnReznick's Transaction Advisory Services Group. Our group works with M&A professionals on buy-side and sell-side transactions. So when you think of an acquisition or a sale of a business, a lot of you may have heard of a quality of earnings report that's generally issued. My team essentially works on putting together a quality of earnings report, a financial due diligence, be it tax due diligence work. Increasingly in the last few months, as you all know, we've done a lot of work on SPAC transactions. CohnReznick overall as a firm supports the various stages of a SPAC lifecycle. So very similar to how David mentioned on the SPAC side of things, we do support SPAC investors or sponsors on the pre-IPO stage, including formation and any advice on the SPAC structuring. Then obviously during the main target search, that's when my team comes into play with respect to due diligence of the target company. And then subsequent to that, with the de-SPACing process, we have a CFO advisory group that helps with anything that's got to do with assistance on the IPO readiness and adding basically additional hands for the target company to get them ready for filing. And then finally, I would say once the public company is public and needs to comply with all the requirements, be it with respect to Sarbanes-Oxley or any other internal audit requirements, that's when we've got a team of consultants who help with advisory roles on internal audits as well. And then similarly, on the other side, where it's on the target company, as you know, a lot of things are evolving with respect to the SPAC businesses. So is our service offering. Till about 2 months ago, we did not realize about the importance of providing what we call a project management office service to target companies that are looking to or have been getting inquiries from SPACs. But we've been actually providing this assistance to target companies who are either audit or tax clients of the firms. But we've now realized that it's important to basically just provide this more as a wholesome package and assist them through the entire process about coordinating with SPAC sponsors and being able to be there as the main coordinating point. And we've been starting to offer that service as well as a project management team. So that's a little bit about CohnReznick and about our practice. I'll let Eric maybe go on with his introduction, and I'll be happy to either take any questions or talk a little bit more about what we are seeing on the diligence side of things.
Great, thanks. And Marianne, thanks again for inviting me to kind of the second Contact with Coffee. Really appreciate it. And again, appreciate the opportunity to kind of share the panel with David and Vikram. And kind of the last time I was on, I spoke a little bit about kind of the volumes we're seeing, but a little bit of background on me. I'm a senior vice president with Sompo International, so on the insurance side of it. And focus on public and private company business. And I guess since in my 16 years underwriting both at AIG and the last 4 years at Sompo, I've had a specific focus on IPOs, which now include SPACs and de-SPACs. So taking up a lot of my time over the last, I'd say, 15 months, given the volumes that we are seeing. So, similar to David's comments, I would agree with respect to the trends that we're seeing in this space. I think we're kind of at a tipping point, quite honestly, where the volume of SPACs in particular have come out, but now we're seeing 430 SPACs seeking an acquisition. We have another 120 that have already announced a transaction. So it's kind of created this. And I'm sure everyone has seen it, what they call kind of SPAC fatigue, both on the kind of service side, definitely on the underwriting side, and just the ability to kind of get to all these deals. And with that comes at least some observations I've seen where we're seeing more serial SPACers continue to kind of proliferate in the market, right? Where for the most part, when I started underwriting these, let's say, 15 years ago, it was kind of maybe a small SPAC team, specific focus, and, they wouldn't necessarily come to market again. Now, what we're seeing is, sponsors that have 2 to 3 SPACs, looking for a transaction, maybe another 1 to 2 that are already in the process of finalizing a transaction, and then, in the process of conducting that many more SPACs. So it creates somewhat of a dynamic that we're working through on the underwriting side, just with respect to some concerns around conflicts, how many SPACs you can have in the market at one time, what the diligence is around those, especially if you're potentially working through 4 to 6, transactions. So that's one observation. We're seeing some more interest in international opportunities where most of the SPACs within the space have largely focused on U.S. domiciled risks. And again, I think that could be the reason for some of the competitive dynamics we're seeing for targets, maybe targets not being ready to go public, but maybe just more value outside the US where, there maybe some more attractive valuations there than in the US. And then I'll just make kind of one more observation that we're starting to see some kinks in this SPAC market, right? Where we're maybe losing a little bit of the shine to David's point. A lot of SEC scrutiny on the underwriting side. We're continuing to follow that. We're seeing increased claims frequency where they're not only targeting the de-SPAC transaction, but the SPAC individuals themselves. And my last kind of comment is, if you look at the SPACs that went out last week, 14 of the 15 SPACs that went out were trading below that $10 price, which again, I think creates some concern and maybe resulting in a little bit of the dip in the market. Maybe allows us to breathe a little bit as we start to see the pipeline build up again, and we start to see more of these come out in the next 6 to 12 months. But I'll take it for now, and then we'll kind of continue to see how the market develops going forward.
If I could just jump in on something that Eric was mentioning. So to the extent that there are undiscovered targets out there, I do think that they're international. And we're seeing that increasingly in our practice. SPACs that never thought that they would be considering an international target are now doing so. The bad thing about that is unless you're organized offshore as a SPAC, it can be quite grueling to structure an acquisition of a non-US company. We do it, but there are tax issues and inversion issues and other stuff that one needs to consider. And then from an SEC point of view, if your non-US target doesn't prepare its financial statements in US GAAP or at least in IFRS, then you're in trouble, and that's an extra work stream that needs to occur there. But all that aside, we work with sponsor groups in Europe and in Asia on, and we're working on a bunch of de-SPACs in those regions these days, and I feel like there's increasing interest in those parts of the world and the opportunity for U.S. market liquidity and growth that a U.S. SPAC offers. There was a question in the chat box about what changes we've been seeing in market terms. I don't know about you guys, but I agree we are seeing, in general, lower warrant coverage for first-time sponsor groups than we used to. It used to be that a half or a whole warrant was pretty much the market standard for a new sponsor group, but now we're increasingly seeing 1/3 market coverage as the starting bid, so to speak. And we've been doing some SPACs that go as low as a fifth warrant coverage, and we saw 1 or 2 that had no warrants at all. So I'm not sure if that's a sustainable model, but the warrant coverage does seem to be evolving. There are some investment banks that are pushing sponsor groups to delay getting their percentage cut until the SPAC meets some post de-SPAC performance hurdles. I'm not sure if that's going to be widely adopted, but it could be. We're also seeing some more flexibility on the underwriting front in terms of the standard underwriting fee structure. It used to be the case that the overwhelmingly most common structure was a 2% fee on the front end at the closing of the IPO, and then a 3.5% fee at the consummation of the de-SPAC, which comes out of the proceeds of the deal. Given that more investment banks are looking to muscle their way into the space, they're becoming increasingly competitive. Some of them are deferring a portion of the 2% to the back end, and some of them are recharacterizing a portion of the 2% as warrants or units or founder shares instead of cash. So there's some increasing flexibility there as well.
I had a question. Maybe Eric could lead off on whichever panelists or attendees. Eric, you mentioned.
Sorry, I'm on mute. So, go ahead. Now we have a question also from Jean-Luc. Robert, go ahead first. Go ahead.
Yeah. I think David addressed John Luke's question, but
Okay.
Eric, you mentioned 15-year history in the space, and I guess one of the interesting things is SPACs aren't a new thing. They've been around for a while. Do the panelists have observations as to how the cycle plays out, and are there things that are unique to this? I guess to the volume or the issuances or the type of companies this go around. So I'd be interested as to how you guys are seeing the crystal ball being played out here, because again, it's not a terribly new thing, but there is a lot of attention, and and whether some of it is COVID related or sort of democratization related. That'll be interesting to get expert input on.
Yeah, I can maybe comment first, and then I'll let David and Eric chime in, or anybody else who wants to add. But from all that we've been hearing, Rob, based on conversations with the sponsors and some of the other players in the market, it seems like it's more got to do with just the change in perception about what a SPAC is. What used to be, I think, earlier considered, like David mentioned, an investment that was either disfavored or to some extent even a taboo investment, say 5 years ago. That's not so much the case. Large investment banking firms have opened up their arms and are welcoming SPAC opportunities. And I think overall, if you think about it, the NYSE and the NASDAQ, these are the guys who are benefiting from excessive filing of all these public companies, and filing fees is really a big way in which they can make revenue. So the ability to be able to have more such companies file there obviously means overall beneficial to everybody else. David alluded to this. I think there will be a little bit of structure that will need to be put in place, more than what already is, to kind of offset this surge. And there may be a little bit of streamlining that will happen further to curtail this surge to some extent, possibly. But again, I don't think anybody wants to interfere with it by putting in excessive regulations and let the market play on its own way as much as they possibly can, especially with the new regime, it seems like. So that's what I'm seeing for the most part. And I think you mentioned this, Rob, the term you used was interesting about democratization of this. I think there is a tendency or an intention to bring in more retail investors. I was actually reading a report from Bank of America a couple of weeks ago, and they actually surprisingly mentioned that the volume of trade by retail investors is actually exceeding the financial institutions in the SPAC space. So it may not necessarily be in dollar terms equate the same way, but overall volume is higher. So I think that does show that it's achieving the purpose that it's meant to achieve.
Yeah, and Rob, great question, and Vikram, I would agree. Just really kind of one or two comments, right? I think with when we saw Virgin Galactic go public through a SPAC, I think again that was kind of the precipice of realizing that you can take some of these larger size, maybe earlier stage companies public through this vehicle. And then you started to see the likes of DraftKings and then some others. And then as that continued to move forward, you had, larger private equity, you had different investment banks, you had different law firms starting to come in. And I think everybody kind of opened their arms to the SPAC transaction, because when I was underwriting it, in let's say 2005, 2006, when I guess you could call it the first, or second kind of SPAC boom, you didn't see those type of companies, right? Maybe those that were looking for some additional financing, another way to become public. And I think, and at least in my perspective, I don't see this vehicle going away. It provides an opportunity for companies to go public outside your traditional IPO that, some view having its own faults. And the ability for these SPAC companies to maybe provide projections and give a little bit more guidance into their business helps them maybe trade a little bit better post transaction than an IPO where you can't speak to those items, and again maybe a little bit of a disadvantage. So that's at least my take.
So Omar has a question about retail versus institutional investors driving all of this. I still think that initial investors in SPAC IPOs are largely institutional, just because that's who you're your big underwriters are going to market this to on the roadshow, and when they put the book of investors together to present to the sponsor group for the pricing, they like to tout the strong institutional support that the offering has. I think where you see more retail participation is in the secondary trading, and that's where we've really seen the broad-based interest in the SPAC structure increase over the last year or so, and a lot of SPAC stocks are driven up from the standard $10 per share or per unit relatively quickly by intense retail interest in the weeks and months following the IPO.
And also, when you have a lot of high-profile celebrity investors, making these kind of investments, there is a tendency to kind of follow suit and to believe in it a little bit more than you would typically believe. When you have the likes of now Colin Kaepernick kind of people following and following the lead and taking a SPAC route, I think Marvin might be very interested in taking advantage of that and seeing what some of the other athletes are doing. And it's not just restricted to football, right? There are so many other sports that you have athletes who are, again, celebrities or actors, Hollywood actors. It tends to have the effect, I think, where you start to get convinced because they have access to all the advisors, and you'd feel they'd be a little more read and aware of what's going on. I think that could also be playing a role.
Every time I see a celebrity investor get involved in the SPAC, I worry that the SPAC trend has jumped the shark. But I think it honestly depends on who the celebrity is and what their role is. Like, I'm not sure. I don't want to badmouth him, but I'm not sure Shaq or Colin Kaepernick or somebody like that will really be adding value to a SPAC management team. Maybe I'm wrong, but on the other hand, those folks do have connections across different industries, and that's part of what you want to see in your SPAC management team. It's a combination of financial expertise, operational expertise, and the Rolodex that will allow you to source a good business combination. So,
David, you're bursting my bubble. I was going to be the star celebrity for a SPAC here, and I don't know what to do anymore.
Well, yours I would invest in right away.
Okay.
Well, I'm curious to almost if the celebrity, whether it's a hype or if it's adding value. Coming back to my initial question to Eric and even Will, Will's, because we've seen sort of from the DNO, the pricing is just like skyrocket off the roof, and we've identified that there's things that we can do, whether it's an insurance broker or carrier. But is that, and Eric, maybe you can share that from an underwriter perspective as you're underwriting. Is it like, we know that the board members obviously create a lot of value, and it's a way of position our client to make them be more interesting for the underwriters and to underwrite. So that could kind of help reducing the premium a bit. So I'm curious, Eric, what is that a hype or is it value? And also, what are something else that the client can do to position themselves for a better premium cost?
It always comes back to the premium, right? Let's be honest, right? Celebrity athlete sponsoring a SPAC is going to create a higher profile, right? It's going to create some additional risk and scrutiny on our side, right? And at the same time, they can provide valuable insight into potential opportunities, again, depending on what the industry class is and what their focus is, right? One of the challenges I'm sure most people saw, the SEC came out with a comment saying, warning investors against buying SPACs that are backed by celebrities and athletes, right? So you take that with what you will, but again, that's an increased risk factor on our side and kind of how we're pricing these. And I mentioned on our last call, but the only way we're able to underwrite these deals is to look at the sponsors and the sponsor team, right? Those are the individuals that we have to bet on that are going to make a good transaction, and that they're going to do the diligence, they're going to avoid the conflicts, and then they're going to create some long-term shareholder value at the end of the day, right? So we're pricing these deals for about 8 years at the front end, and again, I think we've seen some sustainability in the pricing environment and the retentions. We've seen additional capacity come in that has helped kind of reduce the initial shock of, wow, this pricing is getting out of control. But, to my prior comments, maybe on the last session, the pricing we were seeing for SPACs just wasn't sustainable. But, Marianne, to your point on kind of what we've seen over the last several months that have helped, a lot of the SPAC sponsors and the teams have been willing to be a lot more transparent with us. They'll get on the phone, they'll walk us through what the opportunities are, why they're, looking at SPACs instead of maybe your traditional VC or private equity. They're walking through the pipeline, they're talking about the competitive environment. And for me, where I get comfort is when they talk through kind of the conflict, the diligence process, the directors on the board. The challenge that I'm having from the underwriting side that Wills and I look at quite a bit is, I don't necessarily believe that SPACs were, built to create, to take a private equity portfolio company public. I think they were used as an alternative to that, right? Where you have your private equity or your VC, and then you can use the SPACs to take some other opportunities through that public route, right? So we are seeing some where you have an investment interest and then you're taking them public. And again, it all depends on the sponsor, how sophisticated they are. And again, really, going back to kind of some of the comments around warrants, we are seeing some additional clarity and being able to differentiate between one SPAC from another, right? Warrant structure, raise size, management team, industry focus, and things like that. That's helping us kind of differentiate and provide a little bit more clarity in terms of how we're pricing and retentioning these opportunities.
Yeah, I had a quick, this was Rob, I had a quick question, maybe Marvin related. And then I think there was something that actually Bob or some may have a chime in. But Marvin, I think David mentioned the Colin Kaepernick SPAC. I think that's a different one because I think that it attracted the owner of the Phoenix Suns and the like. But that's a little bit more of that's almost like a social impact play, just given how the NFL treated Colin Kaepernick. But I thought that was interesting that it brought in an owner of another professional sports team, different league, but that was like a little statement to to some of the ownership of the NFL that, hey, there's added backing. I mean, am I in left field on that, or did Marvin? Do you agree? Then I'll ask this quick follow up separately. Good.
No, it's not. And yeah, his SPAC is more restorative justice and social justice.
Yeah.
And the NBA and the WNBA has kind of taken the lead on that. And when athletes get involved with them, it can be good and bad. But I think the thing that they're trying to leverage is their connection across different forums, and he was able to get an owner of an NBA team to get behind them. And so it's the value that they bring to them. I know Shaq was mentioned, but Shaq's on his way to being a billionaire, and he has connections and high profile that he can pretty much reach out to anybody. It's not even 6 degrees of separation with Shaq. Shaq can, reach out to anybody across different sectors. And yeah, it can be, a positive, but it can be a negative too, because if you just get a celebrity that's for the reason for just getting celebrity and they're not working and they're not, mining their Rolodex and their connections, yeah, you just have a celebrity, and then and therein comes the risk.
Yeah, that's cool. I'm kind of on the same page. And then my industry question, because we like special sits and some restructuring distress, but I guess WeWork, looking at a $9 billion, a SPAC transaction, a lot of folks thought that was out for the dead, just between, the collapse of the IPO and then COVID and office sharing. Do the panelists or any other attendees have any thoughts on, that was, this is a new lifeline. Is that an avenue that sort of distressed type companies are going to be able to find traction? Do you think WeWork's going to, hold that valuation type of thing?
So we're working with at least 3 SPAC sponsor groups right now that are explicitly targeting distressed companies that, frankly, for which the SPAC structure may well be a lifeline. So I do think that that's an area that is ripe for expansion.
And I would say, Rob, at least the valuation at the de-SPAC side is a little bit more, I guess you could say, maybe more realistic than when they were trying to go IPO the first time around. Obviously, given the issues that they had to work through getting to become a public company. So, I mean, maybe that's a benefit at least that that we're seeing on the de-SPAC side versus the IPO, but more to come.
Yeah, and I may just add, just on your question on WeWork, Rob, I feel that there are just different dynamics with that company, with just the investor that is behind WeWork. SoftBank must be driving a lot of these decisions, and their complete change in strategy from what WeWork used to be when it was founded, with that vision, is not exactly what WeWork is today, or at least that's not what it's perceived to be. Today, it's more of a traditional real estate, office sharing space. And I think there is a sense of urgency with respect to SoftBank to be able to exit and get some value out of that by way of an IPO proceed. So there could be some value to it. This again is just my personal view based on just reading of whatever I've read about the trends around WeWork. But I think it may be a little different from some of the other typical distressed companies that we're looking at. And to Omar's question on the celebrity investors, whether they're really creating value or hype, I think it's perhaps a couple of years, I would say, Omar, from us being able to truly evaluate and comment on that, because by the time these companies have now gotten public, we might perhaps start to see the trends if there is something really faulty in the investment thesis, which potentially has gone unnoticed. It might take a little time for that to be uncovered. So I would say it's still a little difficult to say for sure whether it's purely value or hype. But one thing is for certain, it's definitely creating traction.
Well, thank you guys. We're 3 minutes until 10 o'clock. So if there's anybody that would like to do a closing comment, and I know that if anybody have any, just if I can say, if anybody has any future topics that they are interested in, let us know. If you want, we'll send you a link that you can fill out, maybe more detail on the industry you're focusing on after this. If you want to include your address and you'd like to receive, you can let us know. You put your address in that link that Sissy will send you as well. So then, and if not, you can also let us know if you guys want to come and meet us in person up on our rooftop. We're going to look to do a SPAC rooftop in the spring, in May.
Hey, Mark, it sounds like you're more open to SPACs now from I think a month or two ago.
No, I was the one challenging that it's whether it's a bubble or not. I feel like some of this is bubble-like, but also, I think there's a lot of underlying currents here that are longer term than simple bubbleness. So I was the one pushing back, saying that this is actually, there's something here that is sustainable, I think, in the longer term, but I don't know how much it is. I don't know if it's 100% of what's out there or if it's going to grow by 50% or contract, but it still feels like there's some underlying currents here that you just can't avoid.
Yeah, I'm kind of similar in terms of being like Switzerland, open to both arguments here. So
if I could chime in, I grew up in the high tech space in the 80s. And the IPO was the place to go. It made a lot of people very wealthy. It also did provide, so the debt market provided some opportunity for a company to refinance themselves and move forward. I'm just really concerned. I think, like Rob and, Mark, some comments you folks made is let's not fall in love with something that's got no value. Let's get back to cash flow. Let's be concerned about EBITDA. These are the basics. I've lived through several of these. I've lost money and I've made a lot of money. But, and WeWork, I have some comments about that because to me, that was an airline. They couldn't fill all the seats. and that's a cash flow game, and then imploded.
Yeah, but Bob, I think part of this though is in some of these growth companies, I love cash flow and assets as much as you do and what have you, but you have to look at terminal value, and
Right.
terminal value, is going to be a pro forma, based on certain operating assumptions. So, something that's negative cash flow now, with the right capital and the right, frankly, engineering and operations can be, and that's what I think that's some of the argument of these growth and technology proponents here for biotech to software, et cetera.
Yeah, I'm all for it. Buy low, sell high. Yeah, but you got to construct the right scenarios. But throwing numbers out there and saying something's an $8 billion market, assuming 100% market share, we've lived through some of those. So let's stick to the basics, the numbers.
I think if we look at the SPAC space in total, if we look at the SPAC space in total as an alternative to the private equity space, such that you are providing capital for a manager to go out and make investments, which is what the SPAC is equivalent to, then it comes down to the manager. And if the process, the reason why I asked the question about institutional versus retail, celebrities being hype versus value, is because it comes down to the quality of the manager that drives that ultimate selection of the qualified investment. And then the subsequent add-ons to that qualified investment, because it is essentially a single private equity investment vehicle that is creating one platform that you're dependent upon that manager, his selection process, his or her selection process, to drive the ultimate performance of that SPAC. And so it's kind of, blank check is probably one of the best descriptors of the product. Really just give someone access to capital to go and make an investment without as much regard as investors scrutinize your private equity platforms on, because they're driven by their past performance. And now it seems more like the conversation is driven by the name as opposed to the track record that is going to inform that investment decision-making policies. I'm very curious to watch how it evolves. And I expect there to be a great deal of quality investments made, but also some second-rate investments made just to tick the box. And the question I see going forward is how those second-rate investments impact the overall perception of the product, because it is a great product to provide capital for investment.
Yeah, I totally agree with Omar. And there is a true bifurcation here of how well managers will do, and you do kind of wonder if there's room here for like a rating agency or something like that to track the success of the different SPACs and add-ons and the fund 1, fund 2, fund 3, because whoever gets that right could have also an interesting sustainable